expert and we can go find opportunities for people. If we don't know something, we're not offering it, we might be walking away, and that's a disservice to our client. So I'm just going to go ahead and let you share a little bit about yourself and a little bit of this, and thank you again for being here today. Also, Mariska is an EXP agent. If you didn't know her, now you do.
Thank you so much, and I'm really happy to be here, and welcome to all the new people. This is really exciting. So, like Carrie said, there's some things about seller financing that it doesn't necessarily have to do with no equity. So we're going to kind of go through some of that today. And really, the idea here is, you know, if you could have, let's see here, is this working? There we go. No, there we go. So, you know, what would one or two more sales or closings do for your bank account? So let's just, you know, why have sales slowed? I mean, I know EXP has been doing better than others, but what are some of the reasons why sales have closed? Interest rates is a big one. Financing, yes. Yeah.
People not being able to find where they want to move to, even if they have a lot of equity, it's just still not really matching up appropriately where they want to go.
Yeah, yeah. And all of these, you know, they talk about inventory and you know, housing prices because they kind of went crazy during COVID and everything. And all of those play a role, but I would argue that a big factor has to do with mortgage credit availability. Mortgage credit availability. The Mortgage Bankers Association, every month, you can go on there for free. You don't have to be a member, but they put out a credit availability index every month. And so the vice president and deputy chief economist, Joel Kahn, said that mortgage credit availability did increase in June for the 6th consecutive month. But if you look at the growth, I mean, this is 2011, folks. That's today. It improved, but not much. So we're still, you know, hovering near the 2012 lows. And so to just get a little bit broader perspective, this chart actually goes back 20 years, and you can see that credit availability is much tighter than it was. And what does credit availability mean? It means banks being willing to loan out money. So why should you care? And more importantly, what can you do about it? Well, I think you should care because if buyers can't buy, sellers can't sell. And if sellers can't sell to buyers with financing, you're probably not going to make a commission unless you know something about alternative financing methods such as seller financing and lease options. And you know, there's some others there, but they all kind of fall into that seller financing realm. So I think that there's a lot of reasons why seller financing can make a lot of sense. You know, higher sales prices, you know, you can usually charge, you know, price your house a little bit higher when you're offering that as an amenity. For buyers who would like an income stream, maybe they're former landlords, people who are looking for potential tax benefits, maybe a faster sale. So when I'm talking about seller financing, I'm including, you know, straight seller financing. I'm including wraps. By the way, I don't know if you all knew this, but the VA does allow wraps, not just assumptions, but actual wraps on their loans, subject to, and even lease options. Now, I just have to say something about subject to. If you've got a client who is considering selling via subject to, I beg of you, unless you're an expert, to please talk with me first, because while subject to is not illegal, there's some gurus out there who are telling people that it's just like wholesaling, and I'm here to tell you it is not. It can be done legally, and you can set it up in such a way to minimize the risks to buyers and sellers, but a lot of them today just are not being done properly, and it does put your sellers and buyers at tremendous risk. So personally, I would not broker or, you know, have, it's fine as an investment strategy, but not so much as a brokering strategy. Anyway, that's my soapbox. So I think that it's important to understand that seller financing is not going to solve every problem, okay? It's not a silver bullet. Not every property should be sold with seller financing, but it's a really powerful tool, and it has the potential to solve a lot of problems. So, I think, should I suggest seller financing to my client? In my opinion, I think it's really important to have that seller financing conversation with your client. And ideally to bring it up early in the process, like even before you list. Because even if your client decides, you know what, I'm not open to seller financing initially, your stature as an expert will be raised if you broach that topic first. So you'll look more like the expert. And, one thing you can do, by the way, is just say, hey, Mr. Seller, Mrs. Seller, what are you going to do, especially if you're thinking, this one might not move so quickly, what are you going to do to help me help you sell your property? So when you're doing seller financing, there's some questions that you want to ask that you might not be accustomed to asking. And you need to really find out, what is it that the seller needs? We all think they just want to sell for top dollar. That's not always the case. It's not always what you think. So it's not just, do they have a mortgage or not? Because that is an important consideration, but it's really more about, how much money do they need right now? Would they like to make more money up front, or would they like to make even more money over time than they would with a straight sale? Maybe they're concerned about taxes. Are they looking for a tax strategy? And so there's basically these three paths: more money now, some money now, or less money now. And I just kind of like to put them in those buckets because there's different strategies and nuances within each one. So let's talk about landlords for a second. How many of you have either investor buy and hold clients? Anybody have investor clients? Okay. How many of you have properties yourselves, rental properties? Okay, so this applies to you. The average of all US markets, the cost of buying a house is 60% up over the past 3 years. But rents have only gone up about 22% during that same 3-year period. So in many markets, rents have actually declined since last year. Here in North Idaho, we saw rents go up really sharply in 2021 when everyone was fleeing the left coast, but then they've kind of settled back down again. So if your client had a viable tax strategy, would they be interested in selling? I was just talking to somebody just a couple of days ago, and she had a rental property, and I was asking her about it. I was looking for it for my own portfolio, and she said, well, I'm just going to have to 1031 it. And I said, oh, do you have other properties that you're looking at that you'd like to buy? She goes, oh, not really, but there's just nothing else I can do. And I said, that's actually not the case. When you sell a rental property that has a lot of appreciation, you're likely going to owe a bundle in capital gains taxes, right? And so most people immediately default to the 1031 exchange, and that's great. There's nothing wrong with that, but there are some restrictions because you have to find a suitable property within a certain time period. And what if you can't find that property because the prices are all elevated, right? And maybe you're nearing retirement. You like the cash flow, but you don't necessarily want to own rentals any longer. So seller financing can actually defer and potentially eliminate capital gains depending on how it's structured. And also, there's some other things we want to, confer with their CPA. I would also say, by the way, that not every CPA is familiar with the installment sale. If you give them this code and they look it up, they'll go, oh yeah, that will work. But that's not their default position. They just don't know about it. Ask me how I know. So, let's just do a long-term investment comparison. So today's home prices and interest rates are both elevated. We agreed on that, right? Okay. So when you sell your rental property with seller financing, the monthly note payment that you receive will likely be much larger than the monthly rent payment that you're receiving now. So there's a magic number for buy and hold, landlords, what have you, that's called the 50% rule. And basically it's, who's heard of that? What is it? You've heard of it. Okay, what does it mean?
It's usually like, from what I understand, it's like kind of like dollar for dollar in a way, where if you're buying something, 50%, threw me off. 'Cause
It's okay. Basically, it means that, if once you account for taxes, insurance, repairs, maintenance, your net profit should be 50% or greater. If it's less than that, you're probably losing money. So if those rent checks don't exceed the 50% rule, after you pay for all those things, you are going to lose money. But as a note holder in today's market, someone who doesn't have to pay taxes, doesn't have responsibility for repairs and maintenance, pay for insurance, even a mediocre note would beat the 50% rule at what that looks like. So let's see, the median home price in all of America, sorry, I didn't dial it down for Idaho, but we're pretty close. The median home price in America right now is about $400,000. So that same house, depending on your market, will rent between $1,500 and $3,000 a month. So for this example, we're just going to assume that it's $2,000 per month. Now, as we talked about, most seasoned landlords will agree that their net income is roughly half of that, while the other 50% is allocated towards expenses. But let's compare that to someone who creates a note on that same $400,000 house. The note payment, the monthly principal, interest, taxes, and insurance are going to be about $3,000 per month. Now, the note holder will actually collect $2,300 of that. So if they're only getting $1,000 and now it's $2,300, that's more than double, because they're not having to deal with expenses. Those are being passed on to the buyer, and they're paying the taxes and insurance and all of that. So that's an additional $1,300 per month that the note holder can realize. Not only that, I would say, because of that credit availability, you're also providing housing, home ownership opportunity, not just affordable housing, but home ownership opportunities for people who have been left behind by the institutional banking industry. So who is that? That's self-employed folks, big time. That's somebody who hasn't been on their job for very long. That's maybe somebody who is trying to save for a bigger down payment, or maybe they do have some credit blips that they're working on, or they need to pay down some bills to get their debt to income ratio. I'm not saying we should ignore those things, but I'm saying that the banks are whole cloth eliminating a lot of those folks from their check boxes, if you will. What about appreciation? A lot of times landlords will, raise that objection when they compare note investing to landlording, because, when you own a rental house, of course, the property is going to appreciate over time. And that's a fair question. And I think it deserves a fair answer. So as long as the property is kept in good repair and the neighborhood doesn't decline, the value should increase over the years until you decide to sell it. Now, at that point, you're still going to deal with capital gains, but that's a whole other issue. But let's compare owning a rental house to owning a note. Let's say you have two investors. One buys a rental, one buys a note, and they both pay the same amount. So we're just going to keep everything equal and simple. So over 10 years, the note investor makes double the monthly income of the landlord. The landlord then sells the property after 10 years. They get their appreciation, but the rent checks stop. The note investor has earned more than twice as much in cash flow as the landlord, and they still have another 20 years of payments. So even if the landlord's rental house appreciates roughly at 10% a year, just run the math on a calculator and you'll see how much more a note investor would actually make over the life of their investments. So, Larry and I have spent a lot of time and money learning about seller financing and how to do it properly and all the different ways you can do it. And honestly, I don't expect you to know all of this, but is it okay if I give you a shortcut? Eddie Speed, one of my mentors, he wrote this book back in 2003. And so if you were to read it, he talks about some market conditions that existed then that don't exist now. So the market has changed somewhat. But the principles around creating a good note that will pay remain. So some of the high-level topics that he discusses are, is seller financing a good fit? How to structure the sale and the terms. How to create conditions that are going to prevent default after the sale. and how to sell the note when the time is right. So if you're interested in that, I'm happy to send you a PDF of it. It's a great, I mean, okay, maybe it's not a great read unless you're a geek like me, but there's a lot of really great information in there. So you can email me, info@Evergreen Success, and just put Streetwise book in the subject line, and I'm more than happy to send that to you. So, but real quickly, seller financing, everybody thinks that it's just all about the interest rate, and it's not. It's about way more than the interest rate. So here's some things that can make or break a seller finance deal. We need to vet the borrower. That is number one. What does the collateral look like? What does the house look like, or the property that is being sold by a seller financing? Is there a down payment? And how much is it? What was the source of that down payment? If there was no down payment, then we want to look at things like, seasoning. How long has the note paid and performed and paid on time? What are the terms? A lot of times people want to go for that quick balloon. A balloon can increase the value of a note, but if it's too short, it can actually backfire and make it less valuable. So it's kind of like Goldilocks. You need to have it be just right. You need to have the proper paperwork. It varies by state. It varies by how you're putting the deal together. There are some attorneys that are well-versed. I'm sorry, most are not. So we need to provide them with some education to help them put it together properly. And we have some great contacts as far as just wizards, attorneys who are, wizards in the seller finance and note arena, who will work with other attorneys to help them. So all of these factors make a good note that the seller will be happy with, but they also help create a note that if they should decide they want to sell it at some point, they can get the most for their money without having to take a big discount. So you can do this yourself, or you can hire, professionals to do it. But the thing I want to share with you is something Eddie told me, Eddie Speed, who wrote that book, told me once, the time to worry about a loan is before you make it. And why is that? It's because you can't change the ingredients after you've baked the pie. If you forget to put sugar in the pie, it's going to be sour, and you can't go back and put sugar in later. So if you don't set up the note properly, you're likely to encounter some problems down the road. Now, defects in the note doesn't mean that you can't sell the note, but it does mean that the seller is likely going to have to take a deep discount when they sell. That's just the truth. So what makes me a seller financing a note smarty pants? I buy notes, and Larry and I have been buying and selling and creating notes for over 15 years, and like I said, we've been trained by some of the best. We buy notes. We also sell notes to help people who want to invest in notes. So if you're thinking, hey, I have some money that I would like to, maybe put into my self-directed retirement account. I mean, you can buy notes with that, by the way. But if you have clients or, just someone who maybe wants to buy some notes, let us know. But maybe they just own some rental properties and they want help turning them into notes. Maybe you have a note, or you know someone who does, and you'd like to sell it. Just talk to us. We're happy to, happy to help however we can. So I'm going to leave you with a few key things that you need to listen for from your sellers that might mean you should consider seller financing. Number one is, I can't drop the price anymore. I can't afford 2 mortgage payments, so I'm just going to rent it out. I can't seller finance because I have a mortgage. Not true. I need to 1031, but there's nothing I want to buy. I need the cash. I don't want to hold a note for 30 years. What if they default? What if they trash it? Oh, this seems like a hassle. Listen for those things. Or lease options, all you need to know is, who are you going to call? Just hit the easy button and call me. So go ahead if you want to, take a picture of my contact information. If we have time, I'm happy to take questions, or we can, just do our networking, that's fine, whatever.
No, does anybody have questions? We